How state revenue allocation impacts your business taxes. State revenue allocation is a fancy way of explaining how state governments spend the money they've collected according to their budgets. But for many taxpayers, the real source of confusion is how the money is collected. So let's break down revenue allocation. If your business operates across state borders, you'll know that this can influence your taxes. After all, the taxes you need to pay to different states is calculated through apportionment. In simple terms, this refers to how much of your business income goes to a state government. It's usually based on one of the 3 apportionment formulas, an equal-weighted 3-factor formula that takes payroll, property, and sales into account in equal measures, a single sales factor formula, which bases taxes off your sales in the state, a 3-factor formula, in which the sales factor is given a different weight from the other elements. Surprisingly, not all states agree on how each factor is weighted. The main apportionment methods are cost of performance and market-based tax apportionment. Under the former, income is allocated to the state where your costs are incurred. The latter allocates income to the state in which your market or customer is located. But why do allocation and apportionment rules differ across state? It has a lot to do with state budgets. After all, allocation decisions are influenced by economic conditions, tax policies, and long-term fiscal planning. Yet, all of this can make multi-state tax compliance even more complex, because the policies and laws that guide allocation also guide how tax is collected. For instance, states like California and New York, which tend to spend more on public services, often rely on higher tax revenues to fund this program. As a result, they may have higher business tax rates. On the other hand, there are states that have far lower tax rates because they're more conservative of how they allocate revenue. Consider Texas, which doesn't levy income tax on individuals or businesses. Instead, it relies on a franchise tax. So what does this mean for you and your business? Basically, any changes in policies surrounding state revenue allocation can affect your tax planning and your financial forecasting, but with a few proactive steps, like keeping your planning flexible and using accounting systems that come with automated tax planning systems, you can alleviate some of the stress. And of course, it's also good to work with pros who understand the multi-state climate. At Fusion CPA, we can help you navigate apportionment methods and compliance, so if you need assistance, simply schedule a call with one of our experts.